Hello and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm your nonprofit auditor, Irina Oreshkova, CPA. I have a small firm in downtown Oakland and been serving nonprofit organizations for many years. I design NAPs to provide some feedback and share my knowledge with nonprofit community management about some accounting and auditing issues, and hopefully help bookkeepers, accountants, board members, management to understand some accounting and non-accounting issues and questions, to get a better understanding. Full disclosure, these are not authoritative videos. I'm simply sharing my experience, knowledge to the community. So if your nonprofit have any specific issues, please contact your own auditor or you can contact me. Let's start video 2 for fixed assets. In video number 1, I talked what is the policy for fixed assets, how to create the policy, and what points it needs to include policy. In this video, we will continue conversation about fixed assets, but it will be more practical, how to maintain fixed assets schedule. So once your nonprofit created a policy, which includes main 4 parts, that is capitalization threshold, type of fixed assets and their useful life, depreciation method used, and annual inventory, fixed assets inventory observation, then you need to actually implement that policy. As I mentioned before, this policy needs to be distributed to accounting department and your accountant or bookkeeper every time when fixed assets purchased will include that fixed assets in a schedule. There are various fixed assets software exists, but most of our clients are small nonprofit organizations and they simply maintain fixed asset schedule in Excel, which is very easy to do. And fixed asset schedule has to list every asset purchased. The tricky part is not just to list asset, but properly identify asset enough that that asset can be easily matched with the fixed assets that exists. So for example, if your nonprofit purchased a computer, the bookkeeper do not need to write just a computer in a fixed asset schedule, because organization at the end of like 3-4 years might have 20 computers, and then we would not know which computer that was. So each asset needs to be specifically listed in a way that can be easily matched with the existing fixed assets, so you can perform fixed assets inventory at the end of the year. I would advise to have some sort of identifier, much more specific. Also, do not identify asset like, for example, Irina's computer or Bill's computer, because Bill or Irina might resign next year and somebody else is going to use that computer. So they're no longer Irina or Bill's computer. It needs to be more specific identifier than just the name of the person who is using that computer. Again, it is very important because maintaining fixed asset, meaning performing fixed assets observation at the end of the year. And even though right now, or even by the end of the year, you will remember what asset it is, next year you might not. And also fixed assets typically maintained by bookkeepers, but fixed assets observation will be performing by operation people management, so they don't know what Irina computer means or Bill's computer means. They need to have much more robust identifier. So fixed asset schedule will include name of the computer, name of the fixed asset, then useful life, and that useful life will come from the policy. Then the cost, and cost meaning exactly how much the organization paid for that asset, and then depreciation will be calculated. So regarding the cost, it is very important that under GAAP, general accepted accounting principles, fixed assets are tracked and always maintained at cost. They never ever appreciate it. So meaning they never increase the value. They always stay the same. The fixed assets are not looked at from the fair market standpoint. Fair market value is not applicable for accounting. It's only how much nonprofit paid for fixed assets, or at the moment when it was donated. If the chair was donated, then that cost, that's fair market value when it was donated, stays. So for example, if you are aware, investments for nonprofits are recorded at fair market value. We look at the fair market value of the investment every year, and we do record unrealized gain or loss depending how market is performing. Fixed assets, regardless if the organization owns the building and purchased the building at $2 million, if the next year market goes up and fair market value of that building increases, the organization does not change the value that is on the books because it's recorded at cost. It's very important to remember. It's also very good to know to the board members and to the management that if they own the building or piece of land that was purchased many years ago, 30 years ago, that financial statements report that amount at cost minus accumulated depreciation. So net value, which is not a fair market value, meaning that fair market value might be significantly different. It's very important to remember. So what else we need to put on that schedule? So that schedule also advisable to maintain based on type of the assets. So schedule will include the land if the organization has the land, and it will not be depreciated. As I mentioned before, land under GAAP considered to live forever and does not get depreciated. If the organization have different type of assets, it is recommended to group them accordingly. So if the organization has furniture, it will be one group listed by asset but in a group. Then if the organization has computers, also listed in a group. If the organization has leasehold improvements, it will also be grouped separately. So let's talk about leasehold improvements. Leasehold improvements needs to, an example, it will be everything that the organization does to either to improve the building that they are renting, right? Therefore, because it is rent includes into consideration, because the organization has the rent agreement for a specific period of time, the organization cannot depreciate that asset longer than the period that the asset is leased. Therefore, like I mentioned before, for leasehold improvements, depreciable life should be either, whatever is smaller, either useful life of the asset or term of the lease. Whatever is a smaller, we have to choose. Again, example, if we installing a new roof on the building that we renting, and our rent will expire in 10 years, but useful life of the roof is 20 years, we need to choose the smaller number. It will be useful life of 10 years. What is the difference between repair and maintenance versus improving the asset? So if the organization spends funds to make a change to the asset, sometimes it can be repair and maintenance, regular repair and maintenance, and sometimes it can be improving of the asset. If the organization just simply repairing or maintaining the asset, it's an expense. But if the organization spending funds to make asset better or prolongs its useful life improvement, then it becomes improving of the asset and it needs to be capitalized. So either change to the asset, make it better, or prolonging the useful life of the asset. Let me give you an example. If the organization owns the vehicle and the window of the vehicle was smashed and the organization needs to install a new window, if the new exactly the same window is installed, it's repair and maintenance, and it needs to be expensed, recorded as expense in a year when the repair took place. If the organization decides, because of the criminal activity in the area or make the vehicle more secure, they decided to install tinted windows and maybe with some security features, so it's improving the asset, make it more better, then this needs to be capitalized. It's a capital improvement of the asset and it will be depreciated. So that's the difference between repair and maintenance and improving the asset when it's capitalized. Fixed assets on a schedule needs to be stay in the fixed assets, even if they are fully depreciated, as long as the asset exists. For example, if the organization purchased computers and they use computer and their useful life is 3 years and cost of the computer $3,000, we record it in a schedule and we depreciate straight line $1,000 every year. So cost at the end of the 3, it will be cost $3,000 and accumulated depreciation $3,000. So net is zero. However, as long as the organization still has this computer and still using it, we can use computer for 7 years. It still has to be on your general ledger, in the books, and in your schedule. You do not remove it until actually organization either dispose it, throw it away, or sell it. So if the organization dispose fixed assets that no longer exists, then accounting wise, it's very simple. We just credit the computer asset and debit accumulated depreciation for $3,000 in this case, and it's gone. And we're removing from the schedule. If at the end, when fully depreciated fixed assets get sold, for example, for $100, we do record cash $100 and debit cash and credit gain, because it's a profit that the organization earned on the sale of the computer, $100, and additional entry to get rid of the asset, because again, it's a fully depreciated, we debit accumulated depreciation and create computer asset. So if assets get disposed that is not fully depreciated, it always will be loss. For example, if we take the year 2 computer that costs $3,000 and accumulated depreciation $2,000 gets disposed, then the loss will be $1,000. So debit loss $1,000, debit accumulated depreciation $2,000, and credit computer asset $3,000. So disposition of fixed assets needs to be recorded correctly if the asset is no longer existed. So why, the concept wise, why do we depreciate? Why depreciation even exists? What is the point? Just to understand, GAAP wants to, the one principle of the GAAP is properly match expenses and expenses that the organization incurring. And it would be not representative if in 1 year the organization incur large expense that will benefit organization over the period of time. So therefore, even if expense took in year 1 of computer $3,000, but the organization will be using that asset over the period of time, in this case 3 years, it would be much more representative if we take that cost and allocate it over 3 years, because organization will benefit each year from use of that computer. And the one last part I want to mention, that when do we start depreciation? Depreciation expense start not when you purchase the asset. Depreciation process should start when the fixed asset is put into service, meaning that the organization put the assets for its intended use. Typically, when for majority of the asset, we start depreciation when we purchase them, right? And typically when we purchase computer, we start using the computer and we start depreciating it. Very often we do see the time spread between incurring cost and starting using asset for things such as buildings or leasehold improvement. Sometimes nonprofits build their own asset or do major repairs after they acquire the building. So if the building is purchased but not in use, we don't start depreciating it until the organization starts using the building. And therefore, it is very important to understand once the organization starts using the building, even part of the building, you start depreciating it. So therefore, also, we need to know when the fixed asset was put into intended use. Sometimes it takes time between purchasing asset and assembling the asset to start operating the asset. Then only after we start operating asset, we start depreciating the fixed asset. That was all for fixed asset maintenance. Hopefully it was useful. Thank you for being with me and for this nap. Please join me for the next naps or listen to my previous naps on various accounting topics. Once again, thank you so much. Really appreciate your support and looking forward to see you next time. Bye.